American stock markets declined last week as we anticipated. Were these the leading signals of a major collapse, or was it just another correction? We'll evaluate this and more in this video. Let's get started. As you know, we've been talking about the unhealthy rise in American markets for quite some time throughout 2023. We've emphasized that it will have to come to an end because the fundamentals are not sound, especially the lack of a solid macro foundation. In fact, there have been significant problems in the system, and we've consistently stated that this would eventually lead to a problem and disrupt the markets. Last week, we discussed the double top formation that had been forming for the past few weeks in detail. We analyzed the formation of these double tops in various time frames, from weekly to daily charts. As a result, last week, the market started to decline as we had expected. The market dropped, and Powell seemed to have lowered the market. However, in reality, Powell lowered the market out of helplessness because there was little else left to do. They've been struggling in stagflation for so long that it's as if nothing has happened. They tried to make it seem like certain aspects are unaffected, such as the labor market not being affected, but it didn't work. Despite their efforts, inflation briefly came down with rising interest rates, but it's starting to climb again. Now, they need to raise interest rates, but the economy is too sluggish to allow that. Therefore, it appears that the economy is heading toward a rapid slowdown. But is all of this enough of a reason for a significant market drop? Let's compile a few pieces of news. Next week, in the last week of September and into October, a government shutdown may be back on the table. Republicans, as you know, hold the majority in Congress and haven't approved it yet. American debt has been growing very rapidly since the debt ceiling issue was resolved. It has surpassed $33 trillion, and it may suddenly lead to government agencies shutting down and payment disruptions, meaning the government wouldn't be able to make payments, starting in October. With October, student loan payments are set to resume. The deferred debt of students will come back into focus, and money will be withdrawn from the market again. Last week, the Fed's balance sheet was released, and tightening, in the form of tapering, continues. There was a $75 billion tightening last week, with $50 billion of it directly withdrawn from emergency funds, which are part of the system for smaller banks. We knew that the problems in that area were ongoing. The fact that the money was withdrawn from there raises the question of whether the Fed is intentionally squeezing the market. If a catastrophic situation is unfolding, could they use the government shutdown as an excuse? When we string all of these pieces of information together, we wonder if the charts in the market are already prepared for a collapse. Technically, everything seems fine, but our data starts with a selfie from Powell just before last week's collapse. So, are these scenarios correct both from a macro perspective and in terms of timing? For instance, if we look at past instances, how many weeks or months passed between the Fed's interest rate increases and the onset of a recession? There are different times. You can see in the chart that the gray areas represent the beginnings of recessions. In one case, it was 15 months, in another, 8 months, and in another, 17 months. Most recently, the COVID crisis started 10 months after the last rate hike. So, there seems to be a reason for everything. Interest rate hikes lead to damage in the economy, and they hide it, delay it, and then it explodes. Now, they need to raise rates, but the economy is slowing down significantly, and they can't do it. Therefore, it looks like the economy is heading for a rapid cool-off. However, while all this is happening, did the stock markets listen? The punishment for this may be that they'll meet somewhere down below. So, while everything seems prepared, we can also say that the data is keeping up with it. Let's take a look at some charts. We had mentioned the double top in the NASDAQ. In fact, this left one could be part of a head and shoulders pattern, even though it's smaller. If we include that, then this becomes the neckline. But in any case, the critical level for this double top is at 14,680. We closed just above it, but there were selling pressures throughout last week. As long as we remain below our technical level of 15,000, the trend will continue downward. However, if 14,680 is breached to the downside, things will deteriorate much more rapidly. Let me make that clear. Let's take a look at the long-term chart of the NASDAQ to remember. See that at 16,777 in December 2021, we had a peak, and then in July, we had another peak at 15,945. It's a perfect double top, and there's even another double top within this larger double top, and each of them has performed to the downside. So, this is very important. This week, movements below 14,680 will confirm this, and as long as it remains below 15,000, there is a possibility of a sharp continuation to the downside. We'll closely monitor it at the beginning of the week, especially around those critical levels. Will it try to hold on there, or will it break down directly with all this news traffic? We will closely watch it. S&P 500, there's nothing left to hold on to. It has already broken below that horizontal line of the double top. Of course, you can call this an ABC, meaning it might gather itself up from here. Anything is possible. But it has also gone below the 100-day moving average and is heading toward the 200-day moving average. From a technical perspective, as long as it stays below 4,436, the index of America's largest 500 companies, the S&P 500, continues to appear bearish. For me, Dow Jones, things have soured there too. I can say that it has officially broken down as long as it remains below 34,570. Apple, the world's largest company, had seen some slight rebounds earlier in the week, but then it returned to selling towards the middle of the week. As long as it remains below $179, my trend-following level, there is a high probability of a long-term double top formation. Tesla, my trend-following level for Tesla is at $257. In the second half of the week, especially, it broke down sharply, and there were quite significant sell-offs. While some stocks tried to hold on towards the end of the week, Tesla couldn't find support from anywhere and dropped to around $244. As long as it remains below $257, the direction is downward, and it's starting to approach the 200-day moving average. Nvidia. It's quite interesting. You know that in the world of tech, Nvidia is considered the symbol of artificial intelligence. It was a frontrunner in this rally. You know, it reached around $1.3 trillion in market capitalization, making it one of the few companies in the $100 billion club. It hit its peak at $502, and personally, I've found it expensive since it was trading at $150 to $200. As long as it stays below $426, it looks bearish. Something interesting happened this week. There was a sudden drop in after-hours trading, where the price briefly plunged into the $304 range, which was around a 20 to 25% drop. It was labeled as a glitch, like a computer error, but there were speculations about whether a large fund had offloaded its shares during after-hours trading. Later, it returned to normal. However, it's an interesting symbol. You see, Nvidia had a gap up at $318, and I've been expecting it to fill that gap. So, it's time for the selling to come in. There are many reports about Nvidia, and one particularly notable article in a reputable publication like Market Insider compared Nvidia's current situation to the Dutch tulip bulb bubble of the 17th century, suggesting it might burst. There are other intriguing stories as well. Some involve the company's partners extending credit and then placing orders with the company in a roundabout way. If you do your own research on social media, you'll find quite a lot of unusual information about it. Even serious traders and famous investment experts have made unusually negative reports or comments on the matter. Therefore, strange things are happening, and this could potentially trigger a systemic issue. We are closely monitoring it, and it's essential to remember that Nvidia is a company that could potentially deflate the whole bubble. I've been saying this for months, and we will continue to keep a close eye on it. But as long as it stays below $426, I'm monitoring the technical picture. If you are a trader, your stance depends on whether you're positive or not. I can say that there are divergences since the recent peaks haven't been confirmed. Nonetheless, strong hands have been holding this company somehow, but they can't entirely stop the decline. It did try to find support around $400, and if it falls below these levels, I believe it may aim to fill that gap first. Will there be more to come? We'll see. We're closely monitoring it. Enjin. Why am I mentioning this? Even when healthcare sector companies were dropping during the second half of last week, Enjin managed to hold its ground and continues to trade positively. You know, we caught it at $273, which was the bottom during the summer months in July. Enjin was one of the companies I liked back then, and I mentioned it in these videos. For those who managed to catch it at the bottom, they still have the opportunity to hold it, and they've made some profits with buying and selling a few times. It formed a good chart pattern back then, and I pointed out that it had formed a nice bottom. Now, in the short term, as long as it stays above $263, Enjin might still be on an upward trajectory. There have been some slight pullbacks. It's essential to be cautious because chart formations may not reach their targets in such bearish markets. However, as long as it stays above $263, Enjin can still be a large and strong biotech company even in a tough market. We'll keep a close eye on it. Let's talk about Bitcoin. Well, there's been some congestion in the cryptocurrency market. There have been attempts to push it above $27,000, but it couldn't stay above that level. Suddenly, there were sell-offs. In fact, I started opening some short positions there. I open and close them. But overall, I don't see it being able to stay above $27,000. However, as I was recording this, it was just above $26,500. If it falls below $26,500, the $25,000 level might not hold this time. So, while I'm following above $27,000 on the upside and watching the 200-day moving average, I also see the possibility of a severe downturn below $26,500. Ethereum, on the other hand, is trending downward for me. As long as it stays below $1,630, the trend is downwards. In the cryptocurrency market, if there's a sudden shift away from the dollar, I continue to watch it, as it may still present an opportunity. However, a sudden shift out of the system, like the appreciation of Bitcoin during a banking crisis, should always be considered. Therefore, I look at it separately for such a move. XRP. As long as it stays below $0.5205, the trend is down. It's been below the 200-day moving average as well, and efforts to push it up have not yielded results. However, XRP is an interesting coin for me in the long term. You know, it had won a lawsuit, but in some SEC reports, we also see that XRP is not considered one of the systematically followed coins. So, I still keep a bit of a distance from cryptocurrencies because it's essential to see how they behave during a major systemic crisis. There are significant problems in the system. I'm talking about banking issues. But in the second video of the week, I'll also take a look at American 10-year bonds. You know, what's happening with their charts. I've been expecting them to go up, meaning I've been talking about interest rates in America always going up and how much trouble it would cause. We had understood this even 2 years ago, step by step. Unfortunately, it's happening, and our predictions are coming true. But for those who can endure and for those who can follow the big picture, I hope this information is helpful. I'll continue trying to shed light on your path in these challenging times. I wish all of you very careful, profitable, and wonderful days ahead.